live now.
So they'll get eight.
No, I didn't have time to my hair. What shit is in these gloves? Like, are they so soft? Did you get those with like the hoodie?
What's that?
Well,
When's your class? It's today.
put your hand, especially like, especially when you're
I usually sit on the left side. I mean the right side, I guess.
the work, she lost one of hers, and then she took mine, and then lost. Oh, did you match? Like, so she looks like the same hair. Like, I need them.
Good. How you doing?
It was just like.
It's Steve Clark. Huh? Yeah, Steve in the past.
Okay, we'll get started. So there's a sign-in sheet. Make sure you sign in by the end of the session. And if you guys need to leave at any point, feel free. How many of you guys? Oh, and I'm recording this, and a YouTube video link will be provided to you hopefully by tomorrow. So, quick gauge, how many of you guys already hate this class already? Not too bad, okay. So, maybe some of you guys are comfortable with this. So, we'll start with the first few chapters. It just throws a bunch of basic accounting things at you. Okay, and we'll start with the three financial statements. We start with the income statement. And the income statement tells you how much revenue, how much expenses, how much net income do we get over a period of time. So, for example, our revenues for 2017, our expenses for 2017, and ultimately our net income for 2017. And we have the subtitle for the year ending or for the month ending 20/31/17. So the income statement, we're ultimately trying to figure out our net income. That's our first financial statement we make. The second one is our statement of retained earnings. And with that, we're trying to figure out how much earnings does the firm retain this year. So we begin with our beginning retained earnings, which is all the earnings accumulated over the previous years. We take our net income, the earnings that we made this year, we subtract our dividends, which are earnings that we paid out to shareholders. So dividends, we don't retain them, so we take them out of our retained earnings, and that gives us our ending retained earnings. And our last financial statement, or the last one that we've learned about, is our balance sheet. The balance sheet tells us how many assets, how many liabilities, how many things does the company own right now at a period of time. So for that, we just simply put a date. On 12/31/17, we had this many assets, this many liabilities, and this much equity. In this balance sheet, we take our ending retained earnings and put them into our equity section. And we'll go through all the different accounts in the balance sheet. But in equity, we've got common stock and retained earnings. That's where our ending retained earnings gets plugged in the equity section. So that's the flow of all the different financial statements. The order, the income statement, the retained earnings, then the balance sheet. And if anyone has any questions at any point, just shout it out. Sometimes I don't see hands being raised. Moving on to something else. We've got these three different business activities. We've got operating activities, which I put the definition down there. It's just the day-to-day running of the business, so buying inventory, collecting accounts receivable, incurring expenses, getting revenues, anything day-to-day. Financing activities, borrowing money from creditors or paying off money to creditors. So taking out a notes payable, paying off a notes payable. Taking out a bonds payable, paying a bonds payable. And we've got investing activities. That's obtaining any long-term assets. So buying a building, buying some land, selling some buildings, selling equipment, anything dealing with long-term assets. So here we've got our general accounting equation. Our assets equals our liabilities plus our stockholders' equity. For those who just came in, make sure you sign in that green sheet. So here we'll just write out all the different accounts that we've been introduced to so far, beginning with our assets. Our assets, we can break them up into 4 different categories. We've got current assets, which are assets that we're going to use or receive the benefit from within a year. So good examples are cash, accounts receivable, inventory, supplies, what else we got? Prepaid expenses, so even though prepaid expense says expense in the account title, it's not an expense, it's a current asset. We've also got, I think that's about it, prepaid expense, inventory. I think that's it. We can also break it up into long-term investments. These are still assets. Long-term investments. Again, they're still assets. We've got stocks. And we've got bonds. Those are 2 big ones. Don't confuse stocks that are assets with common stock, which is equity. Same thing with bonds. When it says just bonds, that's an investment, an asset. If it says bonds payable, that's not an asset, that's a liability. So these can be easily mixed up with either equity or liabilities. They're both assets. So another category, we've got current assets, long-term investments, we've got property, plant, and equipment. For short is PP&E. And again, these are long-term assets, so we're going to use these or gain the benefit from these assets over a long period of time. So, for example, we've got buildings here, land, equipment, garages, what else can we have? Buildings, equipment, machinery. Any asset that is long-term, we're going to use it over a long period of time. And then our last category for assets is intangibles. And so anything that we can't touch. So like patents, trademarks, There's a few others like copyrights. About it. So goodwill, some people have a misconception about goodwill. In accounting, we define goodwill as any value over what we paid for a company. So that made no sense. Say we buy McDonald's for $100, unrealistic, but we buy McDonald's for $100. It's valued at $70. So that difference in what we paid and what, we paid for McDonald's for $100, its true value is $120. That difference in value and for what we paid is goodwill. So in that case, we've got $20 of goodwill. McDonald's is worth more than what we paid. Any questions so far? So we can also, I'll go back to this property, plant, and equipment. We've also got these contra accounts that we've been learning about. That's accumulated depreciation. So a contra account is contrary to the original account. So accumulated depreciation takes away from the value of buildings. And maybe that will make more sense once we start doing journal entries. But for each property, plant, and equipment, we've got this accumulated depreciation account. So accumulated depreciation for the buildings, accumulated depreciation for equipment, any questions so far with the assets? So moving on to liabilities, we can split liabilities up into two different categories. Accounting. We've got short-term, or I should say current liabilities. Which again, current means we're going to use them up, we're going to pay them off within the year. Current liability could be accounts payable. That's why when we buy inventory, and we don't buy inventory with cash, so we owe someone for the inventory, accounts payable. And have wages payable. Our employees work for us, but we haven't paid them in cash yet. We can do notes payable, which is when you go to a bank, take out a loan, you owe the bank money. Wages payable, we've got this thing called unearned revenue. Which is when we receive money, but we haven't provided the service or provided whatever to the customer. So we owe the customer a service. So even though it says revenue, it's not a revenue, it's a liability. And we've got long-term liabilities. Those can include bonds payable, which is when the company issues bonds and they have to pay off those bonds eventually. We can have notes payable as well. Now you may notice that notes payable is long-term and short-term, and that's correct. Part of the notes can be due in more than a year, and part of the note can be due this year. So a lot of these liabilities can be split up into long-term and short-term, depending on when they're due. I believe that's it for long-term that we know of. And we'll move on to equity. So in equity, all we really know is common stock. Which is when the company issues shares of stock, people invest in our company. We've also got retained earnings, which again is just the earnings that the company has retained. Self-explanatory. Also in the equity section, so far all these accounts will end up on the balance sheets. But we've also got some equity accounts that will go on the income statement. So we've got revenues. We all know what revenues are. Same thing with expenses, any type of expense, wages expense, depreciation expense, interest expense. We've also got dividends. When we pay out dividends, that's pretty much it for equity. Any questions so far? Okay, so now we get into some math, some financial ratios. So for anyone who walked in late, make sure you sign in on the green sheet. That should be going around. Or just sign in when you leave. So some financial ratios. Let's start with the profit margin. So here we're given a simplified income statement, a balance sheet, and some additional information. Our profit margin, the equation is our net income divided by our net sales. So to get this information, we look at the income statement. The income statement tells us our net income of $54,000. And our net sales revenue of $500,000. That gives us a profit margin of 0.108. And the way you can read this, or the way that I read it, is I say, here's our equation, net income over net sales. Our answer is 0.108. I'm going to put a 1 in the denominator. It doesn't change the answer at all. So for every dollar in sales that we get, 10 cents of it will be net income. So if McDonald's had $100 in sales, then our net income will be $10.80. Okay? Yeah. So this could be useful, like if you project your sales to be $1 million next quarter. You can look at your previous profit margin or a bunch of your profit margins and determine where your net income might be. We also learned in class today about the gross margin. And the gross margin is fairly similar to the profit margin equation. We just take our gross profit divided by net sales. Now in this problem, we don't have a gross profit. We can't figure that out. But that's the equation. So gross profit, if our income statement was more detailed, it would say we've got sales of however much minus our cost of goods sold gives us our gross profit. We'll use the gross profit divided by the total number of sales, and you get your number. Okay, earnings per share. The equation for earnings per share is our net income minus our preferred dividends divided by the average number of shares outstanding So the numerator is pretty easy because they give us those numbers. You've got our net income on the income statement of $54,000. Can you guys see when I write in polite? Okay. 54,000, then our preferred dividends, which is stated right here. We gave out $5,000 in preferred dividends. Divided by the average number of shares outstanding. So that's a lot of words. It's basically just saying what's the average number of shares outstanding. You don't really need to know that right now. Our beginning shares outstanding were 132. Our ending was 150. So we'll take the average of that by adding those up. And then you divide by 2. And that should equal 141,000. So subtract the numerator first. 54 minus 5 is 49. Divided by 141 is 34 cents. So earnings per share, according to Investopedia, it's important in determining or it's useful in determining the stock price, but this number is not telling you how much money you're getting, nor is it what your dividend's going to be, nor is it the stock price. It's just a good value to base the value of the stock off of. Any questions so far? We've got working capital next. So working capital is our current assets minus our current liabilities. that, or to figure out that, we just get our information from the balance sheet. Our balance sheet has current assets at 225, and our current liabilities at 127. That equals 98,000. And then our current ratio, which is fairly similar, is just current assets divided by current liabilities. So use the same numbers, 225 as our current assets, divide by 127, current liabilities. And you should get 1.77. So for the current ratio, again, I like to put a 1 in the denominator, and it tells me for every $1 in current liabilities, we have $1.77 in current assets. So like creditors, or like the banks, if you have a short-term loan, they might want to look at this current ratio or this working capital and see if you have trouble paying off your debts. Well, you've got enough current assets to pay off your current liabilities. So to creditors, a higher current ratio would be better because it's safer. To the firm, a higher current ratio might not be good because then maybe you've got too much cash on hand. You don't need all that much cash. Or you've got too much inventory. And then our last two, we've got debt to assets ratio. So debt to assets kind of gives us the equation in the name. We've got our debts to assets. Our total debt or our total liabilities over our total assets. So again, these are balance sheet numbers. Our total liabilities doesn't have a total column, so we'll take the current liabilities of 127 plus our long-term liabilities of 231. So there's our total liabilities divided by our total assets, which says 925. So that gives me 0.387. And again, this is how I understand it. Debt over assets, for every $1 in assets, 30 or 0.387 is debt. That sounds weird. So for every $1 in assets that we have, we've got 38 cents in debt. Or you can think of it, debt is 38% of our assets. And it's pretty similar to this current ratio. Creditors will look at this and make sure your debt to assets ratio isn't too high, meaning you've got a lot of debt compared to how many assets that you have. So the creditors, maybe a lower debt to assets ratio is better because you've got more assets to cover your debt. But then again, for a company, maybe a lower debt to assets isn't good. You'll learn that in finance, 350. Don't really need to know it for here. Then our last one, free cash flow. Free cash flow is just our operating cash flow, or cash flow provided from operating activities. Free cash flow is our cash provided from operating activities, 870. Minus our dividends, minus our capital expenditures, so here's our cash flow from operations minus our dividends. So in this case, I tried to look it up on the internet. We don't include the preferred dividends in this dividends equation. It's just referring to our common stock dividends. So I didn't have it up there. Let's just assume you have 3,000. I think that's good. All right, so let's say $3,000 in common stock dividends. So that number would be provided to you. Provided to you. And then minus our capital expenditures, which is how much money we spent on buying buildings or buying those PP&E things. So buying buildings, buying equipment. And it just says it right here, we've got $600,000. That gives us 267 as our free cash flow. So that's just pretty much telling you how much cash do we have after spending money on buying assets. That's pretty much all it's saying. So we've got $267 in cash. So those are our ratios. Any questions on those? So that's all information from chapters 1 and 2. There are some other things that we didn't go over, like different types of businesses. Can't think of anything else right now, but make sure you know not just this stuff, but everything else in this line. So now we're going to just move on to journal entries, which is probably the biggest thing you got to know. We'll first start off saying this equation. You guys learned, I guess, the same to learn the debits and credits. The way I remember it, assets are debited, liabilities and equity are credited. When we increase an asset, or when we buy an asset, we have a debit. When we increase a liability or an equity, we credit. And then it's vice versa. If we decrease an asset, we credit. If we decrease one of these guys, we debit. for the most part, at least. So we'll just begin with January 1st. We purchased a building for $50,000 cash. The two accounts that are affected here is we've got a building, that's a PP&E, an asset, and we spent cash, which is also an asset. So as we increase our building, we're going to debit the building by $50,000. And since we're paying with cash, we're going to decrease cash, $50,000 with a credit. And that's on January 1st. So if you guys flip to page 6, we've got all these T accounts that we're going to post to as well. So lots of flipping back and forth, unfortunately. So here's one step in the accounting cycle. We prepare the journal entry. The next step is to post it into T accounts. So each account has its own T account. In this cash T account, we had a beginning balance of $100,000. That's already provided to you as a debit. And then on January 1st, we spent $50,000. We credited cash, $50,000, so that's what we'll do here. Credits are on the right, debits are on the left.